I'm going to be 50%. I want to be 50% in cash or high yield in cash and 50% in deep value equities with clean balance sheets that I think have strong earnings catalysts. And so that's the philosophy I'm building, and that's the opportunity I specifically see in this market. Now, of course, this is not financial advice. This is specifically what I'm doing. And so as I am talking, the market is actually turning negative, which was my expectation. So the mousetrap overall, ladies and gentlemen, don't get that FOMO because you will get caught. Welcome back in, ladies and gentlemen. So in this video, we're going to talk about a lot of different things here because this market, as we go into the open and another war is kicking off, actually gapped up and now is starting to sell off as yields are starting to put pressure on stocks, as we've been talking about on this channel. So behind me is that piece of cheese that you guys see over here. And what does that mean? Well, that is that greed factor that I've been talking about. As yields are going higher, we're seeing valuations really kind of staying flat to going up still in the face of higher yields, and which is making this market pretty unbalanced. And this is where you have to kind of pay attention to what is going on and be a good individual stock picker. Now, on this channel, I recommend just buying a broadly diversified index, but we're going to get into the nitty-gritty of what I think is going on. And once again, this is not financial advice. This is just my opinion and my journey. And so the first thing I want to talk about really quick is going to be the 10-year treasury. 10-year treasury is moving a lot of different things that we do as investors. We have to discount future cash flows. There is more competition for stocks. The capital costs are going up. It's going to restrict capital structures as well. And so there's a lot of things that evolve around yields that we need to pay attention to and be cognizant of. Now, oddly enough, what is taking place? Yields are starting to break out, which I've told you guys that I thought this was going to happen due to the deficits that the United States is running. And then I think yields can actually spike back up close to 5% and maybe even break above 5%. And what are we seeing here? That yields are now pushing above 4.5%, and that's where I think the line in the sand is. This is where stocks start to really respect yields, is when we break above 4.5%, because this is where I believe true restrictive territory is for yields. Now, if you think that yields are not important, think again, because when we look at where the 10-year treasury peaked, it peaked right around 5%, right where the market hit the October lows. And now we're starting to reapproach a zone that yields haven't seen in some time, which is now signaling to markets that we have to pay attention to what is going on with the 10-year treasury. Why has everything changed? That was the title of this video. Why has everything changed? Everything has changed based off of where yields are going. We can go back to 2008 and see that almost nearly 20 years, this 10-year treasury hasn't approached these types of levels. And what have we been hearing about the stock market? The stock market's been front-running Fed rate cuts, which means valuations have gotten more expensive while yields have yet to come down. And to me, this is going to be a pretty big headwind for valuations and end-of-year earnings, which has been my thesis on this channel. I do think earnings are going to deteriorate as the year progresses for multiple reasons. Number one, the consumer is going to run out of spending power, and basically those luxury items are going to go to the wayside, and it's going to be more consumer-based necessities, not those discretionary items. And so we've talked a lot about this, and I'm positioned for that, and we'll get into the portfolio in 1 minute. But to me, it looks like the 10-year yield wants to break out higher, and how high, nobody really knows, but this will be a downward pressure move on the stock market, along with a stronger dollar. And so to go back to how we used to invest, basically going back to 2008, 2009, we can see that yields were not really much of a conversation. We've had a 10-year treasury trading between anywhere 2 to 3%, maybe it touched 4%, but now that we're pushing above 4.5% and knocking on the door at 5% once again, this is going to change our investment philosophy. And this is why everything has changed when it comes down to investing and picking individual stocks. We really have to understand yields and valuations. Not only yields and valuations, we have to understand how companies are levered. With the cost of capital going up this drastically, leverage is going to be a huge part of the conversation when we talk about investing into individual names. So you want to see very good free cash flow, very strong balance sheets where they can withstand multiple years of higher rates, because I do think this is going to be a bigger problem than what the market is pricing in. And we got a reversal in the VIX now going positive. The VIX was negative when I first came into the morning, and all indices were actually up substantially. And we're seeing a reversal of conditions as things are now starting to take place and the market is starting to digest everything that's happening. Now I want to talk through my positioning and how I'm building out my portfolio. If you guys have been following the channel, basically what I'm doing right now is I'm overweight treasury bills. 31% of my portfolio is in a treasury yield. The idea is to stay liquid and try to earn right around 5% or over 5% if you're lucky enough to do that. Where I'm putting the rest of my capital, and you can see how I'm performing to the stock market currently. S&P 500 is flat to down. Most indices are flat to down, and I'm sitting at a 40 basis point move with most of my portfolio still being in T-bills. And how I'm able to do this is I've really looked at deep value type stocks. We're talking about stocks trading at multi-year lows, but all the stocks that I'm picking have something in common here. Okay, whether I'm talking about Pfizer, CVS, Smuckers, or Cisco, they all have something in common. And Cisco was a recent ad on Friday. As it sold off, I would like to add more into Cisco. Really like the setup longer term for Cisco and all the acquisitions that this company has made. Very interesting setup for Cisco futuristically on earnings growth. Right now, kind of just dead money, but with that being said, I'm slowly averaging into it. Would like to see it get into the low 40s, high 30s, ideally to double my position in Cisco. But I want to talk through what all these companies have in common. Number one, Pfizer had an acquisition of Seagen, and I do think they're going to build out their pipeline. And I think the market is discounting this company way too much. It's trading at a decade low and having some things in their pipeline that could come to fruition and really turn the earnings game around for Pfizer. Number two is going to be CVS, another commonality. What has CVS done? CVS has made multiple acquisitions, has tremendous levers to be able to pull to actually grow their free cash flow. The company's valuation is sitting right around $80 to $90 billion, and this is a company that could do over $300 billion of revenue and free cash flow $13 billion. And depending on what kind of levers they can pull, that $13 billion could actually grow substantially in the future. So in my opinion, the acquisitions and future free cash flows of this company is being discounted too much by the market. Number three is going to be Smuckers. Not the consumer staple pick that I personally want to make, but price brought it to this point. With the acquisition of Hostess and the consumer now running out of money, needing to do more grocery shopping, I think Smuckers is in an interesting position. Once again, it made an acquisition, and I do think that they will be able to grow earnings off of that acquisition over the next 5 to 10 years. With a shift in consumer, should be a nice backdrop for this company. Now, Cisco is the one that I'm very interested in and could be one of my larger positions going forward if the price is set to be right. Cisco has made a tremendous amount of acquisitions that reminds me of Microsoft when Microsoft was trading in a range-bound situation between $25 to call it $35 for multiple years. Cisco's kind of been the same animal. Basically traded sideways for multiple years, but has been making serious acquisitions that I do think will eventually pay off. This company does have good free cash flow, has a good balance sheet, and has made tremendous acquisitions that I do think will grow earnings in the future. So all of these companies have something in common. They're deep value plays that have made recent acquisitions that I think will grow future earnings. Now, of course, I could be wrong on this. What I'm really trying to focus on this channel is looking at deep value plays that I think have clean balance sheets, because this is where I think the big reversal is going to come. As we see compressions come in the stock market, I truly believe that we're going to see a pretty significant opportunity on deep value to start becoming a leader versus a lagger in this market. When we look at healthcare, consumer staples, those have been pretty significant laggers, but when we think about a consumer slowing down, they should be outperformers. And so multiple things I actually want to talk through. Number one, the market is still in a serious uptrend. It's still trading above major moving averages. And so to me, it's still a bull market. That's not the question in hand. The question in hand is that it's really ignoring the yield factor. It's really ignoring political tension. And when we do get a correction, how severe could it be is my biggest concern. So to chase these high flyers and high valuations when deep value is kind of on sale and you have yields working, that's the barbell approach I'm personally taking. I think when I look at the overall broader picture here, valuations are extremely stretched to where I'm not that confident of putting that kind of money into anything where I look at it as this is a tremendous opportunity. And so sometimes the best thing to do at that point in time is just utilize the 5% we're given on sitting in cash, build out your cash position. And so when you do get those opportunities that seem to be a little bit more better on the risk versus reward curve, then you know that you can take those opportunities because you built up that cash and you weren't chasing that piece of cheese that's sitting on a mousetrap. So as always, guys, really appreciate your time. We will see you in the next one.